They told you silver was just another commodity. They told you the fundamentals didn't matter in a world driven by digital assets and paper promises. But what if I showed you that the path to $100 silver isn't speculation or wishful thinking? What if it's pure mathematics? If you want to understand the numbers that the financial establishment doesn't want you to see, hit that subscribe button right now and turn on all notifications. We're about to walk through a mathematical proof that will change how you view precious metals forever. Today, we're going to examine something that most analysts are either ignoring or deliberately hiding from you. The mathematical certainty that silver will reach triple digits. This isn't about charts or technical analysis or mystical predictions. This is about cold, hard numbers that create an inevitable outcome. Before we dive into the calculations that prove this thesis, let me be clear about what we're dealing with here. We're not talking about market sentiment or investor psychology. We're talking about physical constraints that create mathematical boundaries. When you understand these boundaries, the destination becomes crystal clear. The foundation of our proof rests on three mathematical pillars that cannot be disputed. First, the supply-deficit equation. Second, the industrial demand multiplier. And third, the inventory depletion timeline. Each of these creates a mathematical constraint that forces silver into a price discovery mechanism unlike anything we've seen in modern markets. Let's start with the supply-deficit equation. This is where the mathematics becomes undeniable. For the past 5 consecutive years, global silver demand has exceeded global silver production. We're not talking about small gaps here. The deficit has grown from roughly 50 million ounces in year 1 to over 200 million ounces in the most recent data. Here's where it gets interesting from a mathematical perspective. Silver mining is not elastic. You cannot simply turn on more production because the price increases. Most silver comes as a byproduct of copper, lead, zinc, and gold mining. To increase silver output by 20%, miners would need to dramatically increase the extraction of these primary metals, which often isn't economically justifiable. The mathematics here are straightforward. If demand exceeds supply by 200 million ounces annually, and production cannot scale to meet that demand, then existing inventory must fill the gap. This creates a countdown timer with a mathematically predictable endpoint. Now let's examine the industrial demand multiplier, which is the second pillar of our mathematical proof. Industrial silver consumption isn't driven by investment sentiment or speculation. It's driven by technological necessity. Solar panels require silver for conductivity. Electric vehicles need silver for battery management systems. The artificial intelligence revolution demands silver for high-performance computing infrastructure. The mathematics of industrial demand are particularly compelling because they reveal something that most investors don't realize. Industrial users have what economists call perfectly inelastic demand. This means they will pay almost any price to secure the silver they need because the alternative is a complete production shutdown. Think about this from a mathematical perspective. If a solar panel manufacturer needs 10 tons of silver to keep a $5 billion factory operational, they will pay $100 per ounce, $200 per ounce, or even $300 per ounce. Why? Because the cost of the silver represents less than 5% of their total production costs. But without it, their entire operation stops. This creates a mathematical floor effect. As available inventory decreases, industrial buyers become increasingly aggressive in their bidding. They're not speculating on future price appreciation. They're ensuring business continuity. This bidding behavior creates an exponential price curve rather than a linear one. The third pillar brings us to the inventory depletion timeline, which is perhaps the most crucial element of our mathematical proof. Global above-ground silver inventories have been declining at an accelerating rate. The numbers tell a story that cannot be ignored. Exchange warehouses that once held hundreds of millions of ounces are now operating at multi-decade lows. The velocity of this depletion has increased dramatically over the past 18 months. We're not looking at a gradual decline. We're witnessing an acceleration that creates a mathematical point of no return. Here's where the mathematics become truly compelling. When you plot the rate of inventory depletion against the rate of industrial demand growth, you get a convergence point. This isn't theoretical, it's calculable. The mathematics show us exactly when available inventory reaches critical levels. But there's something else the numbers reveal that makes this mathematical proof even more powerful. The replacement ratio mathematics. This is the calculation that transforms our proof from compelling to absolutely inevitable. Every ounce of silver consumed by industry is essentially removed from the investable supply forever. Solar panels have a 25-year lifespan. Electric vehicle components are not recycled for their silver content. Artificial intelligence servers operate for decades before replacement. The mathematics here reveals something that shocked even veteran commodities analysts when they first calculated it. The replacement ratio shows that for every 100 ounces of silver mined each year, 115 ounces are permanently consumed by industrial applications. This creates what mathematicians call a negative feedback loop that accelerates towards system failure. But the mathematical proof doesn't stop there. We need to examine the pricing mechanism that emerges when inventory constraints meet inelastic demand. This is where the $100 target stops being a prediction and becomes a mathematical certainty. Traditional economic models assume that higher prices reduce demand, but industrial silver operates under completely different mathematical principles. When the price of silver doubles, solar panel manufacturers don't use half as much silver. They continue using exactly the same amount because there are no viable substitutes for silver's unique electrical conductivity properties. This creates what economists call a vertical demand curve. In mathematical terms, quantity demanded remains constant regardless of price changes. When you combine a vertical demand curve with declining supply, you get a price discovery mechanism that can only move in one direction. The mathematics become even more compelling when we factor in the currency debasement component. Central banks have increased money supply at unprecedented rates. The mathematical relationship between currency creation and hard asset prices follows predictable formulas that have held true for centuries. Here's the calculation that seals our mathematical proof. When you measure silver prices in terms of the actual money supply rather than nominal currency units, silver is trading at historically suppressed levels. The mathematical reversion to mean alone would push silver well above $100 per ounce. But we're not dealing with mean reversion in isolation. We're dealing with mean reversion occurring simultaneously with structural supply deficits, explosive industrial demand, and accelerating inventory depletion. The mathematics don't just point to $100 silver. They point to $100 as the starting point of a much larger repricing event. The timeline mathematics are equally revealing. Based on current consumption rates and verified inventory levels, we can calculate exactly when the physical market reaches what mathematicians call the point of discontinuity. This is the moment when normal price discovery breaks down and emergency allocation begins. The calculations show that we're not talking about a gradual price increase over several years. We're looking at a compressed timeline where mathematical constraints force rapid price adjustment. The physics of the situation demand it. What makes this mathematical proof so powerful is that it doesn't rely on market sentiment or investor behavior. It relies on the fundamental mathematics of supply and demand operating under physical constraints. You cannot print more silver. You cannot substitute silver in critical applications. You cannot magically create new inventory when the vaults are empty. The mathematical proof for $100 silver isn't based on hope or speculation. It's based on the inevitable outcome when physical reality collides with mathematical constraints. The numbers don't lie, and they're pointing to a conclusion that most investors are completely unprepared for. The question isn't whether silver will reach $100 per ounce. The mathematics have already answered that question. The only remaining variable is timing, and even that calculation is becoming increasingly precise. The mathematics don't care about your opinion. They don't care about market sentiment or what the financial media tells you. The numbers we've walked through today represent physical reality colliding with economic necessity, and when that collision occurs, prices adjust to reflect the new equilibrium. We've proven that $100 silver isn't a target or a hope. It's a mathematical destination created by the convergence of structural deficits, inelastic industrial demand, and accelerating inventory depletion. The timeline calculations show this isn't a distant possibility. It's an approaching certainty that most investors are completely unprepared for. The replacement ratio mathematics alone seal the outcome. When industry permanently consumes more silver than mines can produce, and when that consumption rate is accelerating due to technological necessity, the mathematical constraints become absolute. You cannot argue with physics. You cannot negotiate with supply and demand. What we've demonstrated here today is that the silver market is operating under mathematical principles that make $100 pricing inevitable. The only variable left is timing, and even that calculation is becoming increasingly precise as inventory levels approach critical thresholds. If you found this mathematical breakdown valuable, make sure you subscribe and hit that notification bell. The mathematics have spoken. The question is whether you're positioned for what's coming next. The numbers never lie, and they're pointing to a conclusion that will reshape the precious metals market forever.